For tax year 2022, the Internal Revenue Service issued 237.8 million refunds to taxpayers for roughly $512 billion. These are essentially free loans given by taxpayers to the United States government because they've overpaid taxes throughout the year. Today, we'll review Form 1040 that individuals use to file their tax returns to hopefully give you a better understanding of what goes into your tax liability and maybe give you some ideas for planning for the future. Today, we're just going to look at Form 1040, the first 2 pages of your tax return. So these are going to be the summary pages per se. There are other schedules or other forms that you can include on top of this one. However, this is going to be the one that is submitted to the IRS that shows your tax liability, and then whether you owe taxes or you're going to get a refund on the taxes that you've already paid in excess of what you owed for the previous year. So we're going to be looking at the form for 2023. Now, what you see here, again, is the Form 1040 Individual Income Tax Return for 2023. We're just going to walk through some of the big pieces of this tax return, and then you're going to hopefully learn a little bit more about what goes into each line and things to be aware of as you review your taxes, whether you do it yourself or have a professional file the taxes for you or prepare the taxes for you. So one caveat here is I am not a CPA, I'm not an enrolled agent. None of this is tax advice. So take everything that we say with a grain of salt. This is just an overview of Form 1040. So as we start off, this first section is going to be just basic generic information. Your first name, your last name, social security number. If you're married, your spouse's social security number. As you can see, most people are going to be filing for the year January 1st to December 31st of 2023. But if you use a different accounting method, then you would put that here in these boxes where it says, or other tax year beginning blank and ending blank. So after that, we can scroll down and see we've got our home address, city, state, zip code, all that. And then if you live abroad, then you can file your taxes from abroad, but that would be where you're filing from here. Now, if you would really like to, you can donate to the presidential election campaign. This just goes to the general fund that is parceled out between our presidential candidates. So you can give up to $3 for you and your spouse if you really desire that. I don't know if I've ever seen one of those boxes checked though. So next we've got filing status. We've got single, married, filing jointly. Those are going to be our 2 most common filing statuses. Now, one thing to note, this is your status as of December 31st of that year, that calendar year. Now, if your spouse did pass away during that calendar year, you can continue to file as married filing jointly. But those are typically the only 2 that we would see. Sometimes we'll see married filing separate, sometimes head of household, and sometimes qualified surviving spouse. For a 2023 return, if you file married filing separate, enter the name of your spouse. If you checked head of household or qualifying surviving spouse, you'll want to enter the name of your child if the qualifying person is a child, but not your dependent. This next line here about digital assets, that's just asking, did you own any cryptocurrencies during 2023? And did you receive those? Actually, did you receive them as a payment for services, or did you sell them and then thereby need to report capital gains on those digital assets? So there are separate instructions that you would see for that. Next, we've got our standard deductions. And what you want to do here is just take a look and see if any of these things apply to you. Does your spouse itemize? Are you a dependent? Is your spouse a dependent on someone else? Were you born before January 2nd of 1959? Are you blind? Was your spouse born before that date, or is he or she blind? The big things here with that standard deduction is if you are 65 or older or blind, then your standard deduction increases by $1,850. And that can layer for each spouse and if each of them are blind. So let's say you and your spouse are both blind and you both were born before January 2nd, 1959, you would each add $1,850 for your blindness and being above the age of 65. So just take those into consideration. Next, you're going to put in any dependents that you have. If there are 4 more, you just need to see those instructions. Okay, now we're getting into the fun part, all the different lines. So one thing to note here is you can see on line 1, we've got A through I, and then line Z. So line 1A is going to be your total amount from forms W-2. So this is all of your earned income from W-2 filings. So your employer will send you a W-2. You will take box 1 as it shows here, and you'll put all of your W-2 income in line 1A. Similarly, if you have any tip income that was not recorded on line 1A, you'll do that. And you'll take all of those different items and make sure that they are recorded correctly. And then here's our first add line section here. So line 1Z here, it's a add lines 1A through 1H or 1I in this, or 1H in this scenario. So what you're going to do is you're going to add all those together and you're going to put them over here in 1Z. That's our first summation. We'll see a few more of these throughout this video. Next, we've got our tax-exempt interest and taxable interest. If you've got municipal bonds and they pay tax-exempt interest or tax-free interest, you're going to put the total amount of interest that you receive across all sources in 2A. And then in 2B, you're going to list your taxable interest. So again, municipal bonds are not subject to federal taxes, so those would not be included in your taxable interest. Many times 2A and 2B will be the same amount, but 2A will always be higher than 2B if you have municipal bonds. Next, we've got line 3. We've got qualified dividends and ordinary dividends. The big thing to note here is that your qualified dividends are going to be taxed at the same rate as your long-term capital gains. So if you are in that 15% long-term capital gains bracket, then your qualified dividends have the same preferential tax treatment therein. However, if you've got ordinary dividends, those are going to be taxed at your ordinary income level. So let's say you're at the 22 or 24% federal income tax bracket level. So your ordinary dividends are going to be taxed at that 22 or 24% level, whereas your qualified dividends, again, are going to be at that capital gains rate. IRA distributions, lines 4A and 4B. So if you are taking IRA distributions, you're going to put those total distributions in line 4A, and then line 4B is going to be your taxable distributions. For clients that are older than 70 and a half and are making qualified charitable distributions, then line 4A will be higher than line 4B. So let's take an example here that we have a client couple that is required to take out $100,000 between both of their IRAs, but they give $50,000 away as a qualified charitable distribution. Line 4A, what we would see here, would have $100,000. And then line 4B, because they've given $50,000 away as a qualified charitable distribution, we could say $50,000 goes there. And then oftentimes what tax professionals will do is they'll just simply write QCD in that same box so that the IRS knows why there's a discrepancy between line 4A and 4B. Next, we'll look at our line 5, pensions and annuities. If you've got any sort of a return on principal for an annuity that you've been taking, a tax-free element of an annuity or a pension, then again, it's going to be a very similar thing as lines 4A and 4B. You'd put the total in 5A and then the taxable amount in 5B. For our Social Security benefits, you can look back and see another video that we've done. We'll link it in the description about how Social Security benefits are taxed. But the gross amount is going to be here in line 6A. And then the taxable amount, it's going to be anywhere between 0 and 85% of your Social Security benefit. So some people will only have 0% of their Social Security. None of it will be included in their taxable income. Others, it will be 85% that is included in their taxable income. So just make sure as you're looking over these forms that everything is reflected accurately. So again, if you need a refresher on that, we'll link how Social Security benefits are taxed in the description. So next we've got line 7 is capital gains or losses. So with those, you can take capital losses up to $3,000 per year. And let's say you had $30,000 of capital losses in excess of your capital gains. You could take that year on year for 10 years because you've got $3,000 that you can take as a capital loss per year. You can't take it all at once. And at the time of this recording, that is an indefinite period of time. Any capital gains are included there as well in line 7. So then you would add if you have any additional income from Schedule 1 and line 8. And then here's our next sum. So you're going to take lines 1Z, 2B, 3B, 4B, 5B, 6B, 7, and 8, and this becomes your total income. And you're going to put that over here on line 9. Once you've got that, then in line 10, we've got our adjustments to income from Schedule 1, line 26. Again, taking that Schedule 1, we've got line 10 here and line 26 here. These are going to be your above the line deductions. So think about HSA contributions. If you've got tax-deductible IRA contributions that you've made, then those are going to be what you put here in line 10. Now, what we're going to do next is we're going to take line 10 and we're going to subtract that from line 9. So let's say you have $100,000 of total income, and then you've got $10,000 worth of adjustments. Then in line 11, you would put $90,000, and that becomes your adjusted gross income. So for our adjusted gross income, this is where many phase outs happen. We think about the Roth contribution phase out, the IRA deductibility contribution phase out. A lot of those phase outs come from the adjusted gross income. Now, this is different than your modified adjusted gross income. And here's something that we have learned over the years is that your modified adjusted gross income, there's not just one calculation for it. There's a different calculation for modified adjusted gross income, for net investment income tax, for IRMA, for the marketplace tax credit, even for Roth IRA and taxable IRA contributions. So there's going to be different calculations for modified adjusted gross income. So even though you may see an AGI here in line 11, don't think that that is equivalent to your modified adjusted gross income. Work with a tax professional to determine if you are working on your Medicare, your IRMA surcharges, or if you're wondering if you're going to be subject to net investment income tax, or if you're going to be able to have that marketplace tax credit. You're really going to want to look at which calculation for modified adjusted gross income is being used there. So then next in line 12, we've got your standard deduction or itemized deduction. You can see over here on the left-hand side of the screen, you can have, if you're single or married filing separately, that standard deduction is $13,850. If you're married filing jointly or a qualified surviving spouse, it's $27,700. So that's a really high standard deduction. So as you think about ways that you can plan your taxes out, if you are going to be making large charitable gifts, let's say close to $20,000, and maybe you only have $5,000 of state and local income taxes or state and local real estate taxes, you've got $25,000. And if you're married filing jointly, well, then you're right below that standard deduction. So this is where we really got to talk to clients about when does it make sense to take the standard deduction? And maybe are there ways that we can clump and bunch multiple years of charitable gifts so that we surpass that standard deduction? Again, standard deduction for married filing jointly in 2023 was that $27,700. Next, we've got qualified business income. If you are self-employed, then you can get a qualified business deduction income. Again, this is one of those places where we got an additional form 8995. So you're going to take all of those lines 12, 13, that's that standard deduction and the QBI deduction. And then you're going to subtract those from line 11, and that becomes your taxable income. So we've just gone through the income, and now we're going to go through how the tax is calculated and then your payments. So line 16, you're going to have to see those instructions there because we have a graduated tax rate. Only some is going to be taxed at 10%, some is going to be taxed at 12%, and then upward and upward and upward. So not all of your income is taxed at that highest level of your taxable income. So because there is a little bit of calculation here, you just want to take a look at that and make sure that either the software that you're using or your tax preparer is calculating that correctly. So then from your base, you're going to look at lines 19 and 20 and see if there are any deductions that you need to make below the line. So think about non-refundable tax deductions. So those oftentimes would come here in this tax and credits. So after we've figured out the line 16 of the tax, then we can look at the lines below, and these are below the line credits that you would think about taking. So these are oftentimes credits for home improvement repairs, such as those solar or home energy credits that we talked about in a previous video. Sometimes those are qualified electric vehicle or clean vehicle credits. Lots of different things that can be here as either refundable or non-refundable credits. You're going to want to make sure that you classify those correctly both in lines 16 through 24, as well as in lines 25 through 33. Just make sure that you're getting the full amount of those credits that you deserve. So then lines 24, you're going to take line 22 and 23, and you're going to add those together to get your total tax. So this is your total tax due for that year, for 2023. So then once we've got that total tax determined, then we can look at how much you've had withheld from your W-2s, 1099s. And then line 26, what we see is what are those estimated payments that you've made throughout the year, and then any amount that was applied from your 2022 return. So let's say you overpaid in 2022 and you just said, hey, I want to roll that amount forward and apply it to my 2023. That's where we would get line 26, are those estimated payments and then those forward rolled over amounts. Next, you're also going to look through and see, do any of these other tax credits apply to you? The American Opportunity Tax Credit, the Additional Child Tax Credit. So again, make sure all of those are being calculated. And then line 33 here is where we get our total payments. So that is how much you have paid. So in line 33, again, we've got our total payments. In line 24, we've got our total tax. So let's say you've got total payments of $15,000, but a tax of $10,000. Well, then you would have overpaid throughout the year. You would have given the federal government an interest-free loan that they just have been able to take your money and use it how they want, and they're going to refund it to you at the end of the day. So when you see that, you've got a refund amount overpaid, line 34, and then you're going to give them your routing number and bank account number, and then they will submit that refund to you. If you want instead to have your overpayment applied to your 2024 estimated tax, you can also do that by putting that in box 36. Now, on the other hand, if you have not had enough withheld, or you had maybe additional capital gains that you incurred at the end of the year that you weren't expecting from the sale of some stock, or from stocks that paid, or mutual funds that paid higher levels of capital gains than you expected, then let's say you have a tax liability of $15,000, but you only paid in $14,000. This is where you would have amount that you owe. So then you would have to submit a payment to the IRS for that additional $1,000. So that's a highlight of our Form 1040. Again, this is not comprehensive. This doesn't say anything about your specific tax circumstances, but if you do have questions about your 1040, clients, if you want to reach out to us and ask questions about something that was confusing to you on your 1040, we would love to walk through that with you. We hope this was helpful, and we will see you again next time. If you like these financial planning videos, please share it with a friend, and if you have questions, go to our website at SeriousRetirement.com. This content was provided by Retirement Planning Services. We are located in Knoxville, Tennessee. You can visit our website at SeriousRetirement.com. The information in this recording is intended for general educational and informational purposes only, and should not be construed as investment advisory, financial planning, legal, tax, or other professional advice based on your specific situation. Please consult with your professional advisor before taking any action based on its contents. Advisory services offered through Retirement Planning Services, LLC.